Very good. Thank you for those here in attendance this morning, as well as those who may be listening to our recording. This morning, it's actually going to be, at least as far as what I've got intended to talk about, a fairly short discussion. Mostly, I wanted to answer any questions that people had about managed futures, which is the article that I sent out for a monthly report. It described managed futures, how they operate, some details, fairly briefly. That was the idea, is to just give the core principles in a way people could understand. And anyway, I wanted to make sure that people could ask any questions they had about that. Wanted to go over the economy just really briefly, number two. And then number three, wanted to show you a real flashy looking 2-page thing I made this morning that shows our recent performance of the tactical allocation portfolio versus the stock market and a 60-40 portfolio. 60% stocks, 40%, no, excuse me, 55-45 portfolio. Anyway, we'll get to that at the end. So I'm going to begin with the economy because I have a feeling that some people watch these, attend these, and I know at times we've had some pretty big attendance when the economy and markets really got crazy. They're not 100% there today, but we're there today. This was different the last month than almost any month I've experienced since almost September of 2008. The markets haven't come crashing down like they did in September of 2008 yet. But what I'm hearing from the investment world is getting to sound a heck of a lot, actually a lot like the tech bubble when it burst in 2000. It's looking a lot like that. I had a client, we have a client who's a great guy, sent a video to me the other day that showed the interview where Jeremy Grantham, who I quoted our monthly report, spoke recently. And it's more and more of what I'm hearing. Jeremy Grantham is a legendary investor. I mean, I've listened to him for over 20 years and probably about 1 million other people have too. Most of the smartest investment people have always at least listened to Jeremy Grantham. Well, he came out last week and said, don't ask when this is happening, basically. It's happening now. And the closest analogy, it's like the tech market's following the 2000 collapse, playbook really closely. Tech stocks are down 23%. Well, guess what? Back then they went down 83. And he didn't say they were going to go down 83. What he did say was basically the losses are going to be huge. Hold on to your hats. I heard Jamie Dimon say that. I mean, this guy, the head of JP Morgan, who the market listens to perhaps more than almost anybody. He's the most rose-colored glass guy you'll ever see. I have very little respect for him, not because he's not smart and talented, because he's probably brilliant and I know he's talented, but he's completely dishonest. He says positive things every day of every year because he makes more money when positive things happen in markets. Even he said, brace yourself for the hurricane coming. So I could go into 100 details, but in one word, that hurricane basically comes down to inflation. And I've been saying this and people most still don't seem to get this one fact. Inflation is like a wildfire. It burns everything it touches. We have inflation now going on a year over 8%. it's expected to have gone up another annualized 8% last month. It's not slowing down yet. And it hurts, it damages seriously. When I say damages everything it touches, what does a wildfire do? It doesn't heat it up so you can put it on, your margarine on your butter, on your bread to eat. It destroys. That's what inflation does. And the difficult thing for people is it happens real fast, and because it moves so fast, you can't predict what it's going to do. I mean, because it might burn this down tomorrow, which is connected to that, which is connected to that, and it's happening quickly. A year of inflation like we've had, the damage is already big. Another year of it? No way. But that's what some are thinking is going to happen. Yeah, the Fed will just keep kind of doing half measures. Well, if they keep doing half measures, we'll have another year, most likely, of 8% or more inflation. That's death to a whole lot of things, including the markets, by the way, and including most retirees' finances. Because an extended inflationary time period, when asset prices end up going way down and you're retired, so most people's account value goes way down, and now everything you buy for the rest of your life ends up costing 35% more. So if it ends up being a 2 to 3 year inflationary time period, just at 8%. I mean, we're already in the middle of such a time period. If it continues for another year and a half, for example, 3 years at 8, that's a quarter. Round it off, because inflation goes so fast, it's always understated. We're looking at a third more expense a retired person is likely to have for the rest of their lives. And most of them will enter that time period where they're living it now. But by the time it's done, their assets will probably be a third as much. I mean, inflation is the killer of retirement finances. Full stop. It also kills your economy. Full stop. The people talking about, are we in a recession? No, are we going to go into a recession? Whatever. I mean, yes, the economy contracted in the first quarter through whatever nuance of the bizarreness of current economic gyrations. It could be positive or negative, a positive or negative number for the second quarter. But when you have consumers every single month, month after month after month, with less money to spend, I mean, and you have businesses at some of the most negative views on capital expenditures ever, and you've got huge businesses, corporations now saying, we're done hiring. Some starting to lay off, others, no way, we're not touching it. I mean, and this has only begun, folks. This is the second inning about, I predict or suspect. So that's my take. And by the way, we could have a symposium. We could have Wayne talk for an hour about Europe's problems, and Bill, whoever wants to talk for an hour, actually a day or a week, about China's problems. I mean, what's going on with the Japanese yen is something I've never seen. The yen is getting hammered. And the yen is almost always the flight to safety throughout the Asian world. Okay, when risk hits, the dollar and the yen are the safe places to be. Not this time. The yen's getting killed, and it's getting killed against the Chinese currency. Ooh, that could spell the mother of all currency wars between China and Japan. By the time something like that's happening, we probably won't even, I'm not sure we'll even notice, because we don't need any impetus at this point to derail us. But by the way, Europe, I heard a hour-long presentation by the chief guy who was the chief economist for is Allianz the second largest financial institution in the world, Jeff? I heard their top economist, and it's the largest European financial institution. And their top economist talked for an hour about Europe today. This guy knows a lot. Mohammed El-Arian. I mean, knowledgeable doesn't do him justice. His average lunch involves sitting down with heads of central banks around the world. And when he describes what's going on in Europe's financial, where they sit, when he got done, it was like, there's no way out of that. I mean, I have no idea what's going to happen. Less so than at probably any day in my life, with one little bitty exception. The only thing, and the reason I know less today about what's going to happen economically than any other day of my life, is all due to that word inflation. It moves so fast in destructive ways, and our entire edifice is built on so much bad debt around the world, and keeping that debt from showing any losses. And that's impossible to do when interest rates are going up, folks. It's impossible. So, but because of the inflation, which is just blows and makes it's like, I mean, inflation is also like a fire. There's so much smoke. How am I going to know what's going to be left? The one thing I'm pretty sure of is called volatility. In fact, I'm probably more sure that volatility is going to increase and continue to be higher all around the world than any other thing I've ever been sure of in my life, even as I'm less sure about everything else. Yeah, Wayne.
One question is Russia, and I hear some other countries, I'm not even sure if China's in there, considering or going to gold-backed currencies. How will that affect them, or will it, with inflation?
Well, I mean, if any economy that was backed by gold, their currency was backed by gold, you can't get inflation. The only way you could get inflation in such an economy would be if all of a sudden one country found, I don't know, it's complicated. You don't get inflation with gold-backed currency. That would solve the problem, but that's why no central bank has wanted it since it disappeared, because they want to be able to inflate things.
So didn't Russia go to gold-backed and only sell oil in the ruble or gold?
That doesn't make, however, their currency backed by gold. It simply makes those transactions they required to be done in gold. So, but going more to gold as a currency, I mean, personally, I know there are huge pros and cons. I would much prefer it to the tyranny of central bankers that we've had since the day the gold standard ended. I mean, I know the pitfalls. I know the sort of inherent irrationality of it. On the other hand, it had a ironclad grip that kept central bankers from being able to create debt. I mean, you could not create a debt bubble when your currency was tied to anything like that, anything scarce like that.
So Russia then hasn't tied their currency. They
No.
just sell oil in either rubles or gold.
Correct. Exactly. Completely different.
Thank you.
So anyway, I want to move on to, let's see, the second thing we wanted to discuss. Any other questions before we move on right now about what? Oh, here's a question someone might ask. So Richard, is inflation going to keep going up or go down? A year ago, 1 year ago, I was in the camp along with, by the way, in my defense of my camp, I was with every great economist I know, looked at the inflationary situation going on 1 year ago today and said, yeah, it's getting concerning, but look, the majority of it is transitory. It really is. And the forces that are going to go against that inflation will be growing, whereas the inflationary forces should be receding because they were COVID related. On the other hand, I was not your Fed chair. Had I been your Fed chair, I would have looked at it and said, well, how safe am I in saying I don't think inflation is going to continue at this elevated rate? And I would have said 50-50. Well, if I'm the Fed chair, 50-50. Are you kidding? I know what inflation does. If it's 50-50 at the June 21 meeting, I would have raised rates 1%, at least half. In other words, a year ago. Now they're way behind the curve. They're so far behind. And the markets have been telling them they're behind. The bond market, thank goodness, event is a heck of a lot smarter than the Fed people and ultimately does control them. The Federal Reserve Board is owned by and controlled by the largest investment banks. And guess what? There's a backup to their folly, and that's called the bond market itself can force them to do what they otherwise won't do. So when they raised interest rates 0.5% 2 months ago, the bond market threw a fit. Yields started to spike. Interest rates throughout the economy started to go way up. Mortgage rates, once upon a time last year or so, were at 3. They're at 5.3, I believe, today. So you see the bond markets, the debt markets really don't listen to the Fed at the end of the day when it's real. You know, when it gets real, they will take care of it. And that's always been the case. It's just that the bond market hasn't had a real reason to revolt on the inflation topic for 40, 50 years. I mean, since 1982. And so, but it's happening. The Fed can stop it by putting their foot down, and there's a chance the Fed will eventually have to do that or inflation won't end, because the bond market can keep jacking up yields. I don't know. We've had so few times when inflation really got out of control. And when we have in the past, the Fed took action. Most of us have continued to assume the Fed would act this time. And I still believe they will, but there's every reason to believe. And this guy, Mohamed El-Arian on Bloomberg this morning was saying this was a major part of his discussion. They may do what the market thinks today, which is they raise it 0.5%. 2 months ago, they raised it 0.5%. Is it next week or is it this week? Anyway, they raised it 0.5% now, another half, and then maybe in August, and then they pause. So the market's view and the Fed's talk is still putting out the view, oh yeah, we're going to raise it, say 1.5%, and then we'll pause. Don't worry. We're not going to go overboard in dealing with this inflation. Guess what, folks? Anybody who's studied inflation, I've studied it for over 20 years as my main area of study, knows that is the biggest BS you've ever heard. And that's what that guy, Mohamed El-Arian, was saying. You take that approach, that's not how you stop inflation. You stop inflation by stopping inflation, and you have to be willing to say, damn the torpedoes, which in this case, unfortunately, is our economy. That's why they're not doing it. It's not like There's no way out. Yes, Wayne.
Richard, I mean, my thought is discretionary spending by the public is already starting to dip. I mean, one of the biggest things that should reverse inflation is if you get rid of demand. Is there a chance the Fed is just saying, we're not going to take care of it, be the bad guys, we're going to let the go into a recession and people start tightening their belts and getting rid of demand to do it?
Actually, Wayne, you just described exactly what I would do if I was the Fed and my image was the most important thing to me. Okay. Because if I was that person on the Fed, I still would have read the mathematical analysis that attempted to prove 3 months ago that the Fed couldn't raise interest rates more than 1.25% before everything would collapse. Now, I don't know if that's true. They didn't give out all the numbers and I probably couldn't read it anyway. I'd do all those. I don't know if I know that kind of math. But I've seen a lot of other stuff like that, and I believe it. I mean, pretty much you can't raise interest rates. There are known mathematical relationships between the level of bad debt, the overall level of debt indebtedness in your society, and how much that situation can take in interest rate increases. I believe it's way under 2%. I believe that, and the Fed has to know its own economists from Dallas, the Dallas Fed, and they have to know the debt economists from the Bank of International Settlements, because that's all they do is share data with them, showing that by September, it's all going to come crashing down anyway. So if the Fed doesn't really address inflation, just does 0.5% each 2 more times, they will have done the perfect amount. If they do nothing, they'll get tarred and feathered. If they do 1% and it immediately comes crashing down, they'll be tarred and feathered. If they do 0.5%, and then it just comes crashing down, people may forget they were involved, which is what they hope. They hope, because otherwise, I mean, in a just world, it wouldn't happen this way. In a just world, someday a bright light would get shined on them because they're the main cause of all of the economic suffering coming. They're the number one cause. But I predict they'll walk away scot-free. They'll raise interest rates, and then in the recession, which we probably are in, and if not, look out. Or as Jamie Dimon said, brace yourself. That recession indeed is going to crush demand. And demand, the reason I think we're probably in it is I saw a program this morning, demand is being crushed, again on Bloomberg, is being crushed right now. There are people all over the country setting up new carpools because they can't afford to drive to work. Okay, you think demand on the part of those people for, you name it, if it's not gas or food, they don't demand it. I mean, so you crush demand, and which is happening, and you end up falling into a hole. How far that hole is, again, to quote Jamie Dimon, he doesn't know if the hurricane coming is, Sandy Hook or not. In other words, is it a category 5? From my position, I was looking yesterday to see if there's a category 6. I think there isn't. But of course, I've been accused of being unusually pessimistic about these things. And I'm not sure it's going to be true this time, because the bad debt that I claim is at the heart, the bad corporate debt that I claim is the rot at the heart of our financial problems that are now going to come to surface, has not even begun to bleed. I mean, it really hasn't. And it's going to bleed trillions of dollars of losses all over the place. And those losses will be connected to the biggest wave of corporate bankruptcies since 1932 or 31. So, and it hasn't even started. That has not started. What is the probability it doesn't happen? I know how to stop it, in case you're wondering. We all know how to stop it. We saw it happen in March of 2020. Okay, it's a simple playbook, works like a charm. Congress needs ASAP to pass a bill. The Biden administration, Biden needs to sign it. President Biden signs it, and it needs to give out, say, $2.5 trillion randomly to everyone. And if that, then a year later, they need to sign another bill and give out another $2.5 trillion, just as broadly as possible. And they need to keep doing that forever. That's how you stop it. If you don't do that, there must be something from Shakespeare that would summarize this part. Neither heaven nor hell, man nor, no, there's no way out. And the reason I've always been so confident on this one topic, in other words, how this all ends, is because the beauty of debt is that stinking, rotting debt never disappears. It hasn't. And I've always believed the bigger the pile of stinking, rotting stuff you've got in your basement, the worse it is. Call me pessimistic. And since it truly never disappears, we got 12 years of it getting ready to come to light. That's why I have always been so focused on that. That's where the money is. That's the trillions in losses that are going to start the ball rolling, that are going to be tied hand in hand with the economic difficulties of the next 24 months. So anyway, that's my view of the economy. I do have rose-colored glasses on, because I could see a way that it comes out in extremely positive for the US economy. It's actually fairly simple. If we were ever to let the chips fall where they fall when it comes to corporate losses, if we let the business community, investors and companies just experience all the losses that they would normally experience in a functioning market, if we were ever to let that happen, all of the dead weight would get wiped away through our economy. Then we could rebuild. I mean, the rebuilding is always already going on. There's always new stuff, so it's not like you have to start from scratch. All you have to do is wipe away the dead weight, which we haven't done since 2009. Anyway, I promise to move on. Let's look up next at the tactical allocation portfolio. How have we been doing given what I'm describing? What I'd like to do now is share this screen with you all. It's just 2 slides. Okay. So, I don't even need to, I can just do it like this. Can everybody read this? Jeff? Amber? Yep, okay.
Yes, we can read it. We can read it.
Okay, so this shows the tactical allocation portfolio recent performance. Now, I want to make sure everybody understands what you're looking at. We have 280 whatever number of clients. And in the tactical allocation portfolio, we've probably got 200 families, 200 individuals, lots of families invested this way. Out of that 200, I don't know, I'll bet half of our clients don't have exactly the same as the core portfolio. They might own a little of this or a little more of that. Modest differences, some bigger differences, some smaller. What I do every day when I want to look at how the tactical allocation portfolio is performing, I simply pull up the client who comes first in the alphabet, who has exactly our core holdings. And this is how he's done. I notice over the last 3 years, it's now made 6.77% a year, 7.58% over the last 12 months, 5.53% this year. And by the way, those don't really concern me that much personally, because to me, the opportunity to finally, hopefully do really well, sanity starting to return to markets such that without taking crazy risk, you could start to make good money. That to me actually began January 1st. In our portfolios, it didn't really begin until February 1st. And the reason is January was a transition month where things started to become clear. And I thought this probably now is the end for the stock market. And whoops, inflation is not transitory, which means not looking real good for bonds. In fact, it's not looking good for anything, even gold and silver necessarily. So I started to make the portfolios, number one, inflation protected. So right now we've got about 15% in commodities and gold and silver. That's called, the first part in particular is called inflation protection. And then more managed futures, and then more managed futures. And the reason is they give both inflation protection and protection against risk wherever it occurs. So I'm focused mainly on since February 1st, which as you can see on this screen, we're up 7.27%. Notice down below for the S&P 500, the stock market. Year to date through yesterday, the stock market was down 13.6. That's why I call this the beginning. I think of this hurricane coming to markets and the economy. I think it like a hurricane with 4 concentric rings, each one getting bigger and bigger and worse and worse. We just saw number one, stocks went down a modest 13.6. Since I got us in sort of sailing in the right direction by February 1st, the market's gone down 8.94. We've gone up 7.27. Now, keep in mind, that's a pretty random statement in reality when you consider our portfolio has almost no correlation to the S&P 500. The way we've got it set up now, it's got about a negative 0.1 correlation to the S&P 500, well, closer to 0.05. A slight bias to going up when it goes down, but it's not, people miss the point. The point is, we're not connected to any single market at really much at all. What we're connected to is volatility. Volatility anywhere is good for our investments. Volatility everywhere is great for our investments. Sustained big volatility is nirvana for our investments. When would you have big sustained volatility? That's actually a legitimate question. Anybody know off the top of their head? When would you have big sustained volatility in any markets, but in markets in general? Well, the answer is when you had a worldwide severe economic and market downturn. In other words, our portfolios through these managed futures are set up exactly to profit like they have if this continues. Now, I'm not going to talk about how much we might make because y'all can do your own math. We don't know. We don't know what will happen. I mean, and like I've said, I know less today than I ever have what's likely to happen in markets and economics. It's almost anything's almost possible. I believe except one thing, and that is that volatility goes away and everybody looks around and says, hey, everything's great. Nothing to see here, folks. Are you kidding? Then I just wanted to show you slide number 2 shows our current risk level as measured by our standard deviation. Right now we're at 7.5. I'm planning to sell the Rational Tactical Fund. And for anybody who still has First Eagle Gold, I'm also probably going to sell that. Add that to managed futures, giving us 72% in managed futures. That's the most I'll do. That'll give us a standard deviation once I make that final trade of 8.3. To put it in perspective, the Vanguard mutual fund that it is indexes with 55% in stocks and 45% in bonds is at 11.26. Of course, there's another difference between their fund and what we're doing. They've lost 11.36% this year, and we've made 5.53. So I guess in closing this part, I'd just like to say, obviously, this in no way, shape, or form says anything about our future returns. It does, past performance is not, in this case, it truly is not representative of what I expect to happen. There are specific reasons it's come out the way it has. Those reasons, however, paint an extremely positive picture for our prospects going forward. So with that, I would like to see if y'all have any questions, because I would expect some. Let's see, it was so confusing. You don't know where to start.
I have a question. This is Catherine. Will you stop sharing your screen?
Oh, please, thank you. There we go. Thank you,
Hi.
Kathy.
As often, my question is about real estate, as I'm thinking of possibly selling my house,
Right.
and definitely on the big fence about it. With the volatility, I suppose we can assume that housing costs and prices are going to do the same thing, right?
Yes.
Even in highly established counties that don't fluctuate a lot.
Yes. Okay, let's talk about this, because I want Jeff to speak about it also. And anyone, please feel free to chime in on this topic, because real estate is a very important topic, obviously. And given what's coming, particularly if a person's thinking of selling, obviously it's hard to get more important of a financial decision. Real estate doesn't worry me like it does, like almost every other market does. I'm concerned though on one level. When I look at my house, okay, for example, and I look at how much the one just next door sold for last week or 2 weeks ago, I do not believe that number. In fact, that number is about 40% higher than it was in January of 2020. I don't believe any of those gains. And if they all disappeared, I wouldn't think anything bad had happened. I would think that a little sanity returned to our real estate market. I mean, that's only a year and a half. How long was that? 2021, 2.5 years. Okay, no, that was nuts. So if that 40% disappeared, Yes, I expect it to. That doesn't mean I'm worried about real estate actually as a market. I only worry about a market in terms of its stability and viability, so to speak, if there's too much debt involved. Well, the housing market, correct me, please, Jeff, if you've seen it differently, but I don't see a lot of over indebtedness in the housing market. Quite frankly, with some of the housing pricing I've seen in this year, I've seen an overreaction in the mortgage market. We've seen high quality mortgage bonds, I think, go down way more than they should have. But these continued housing prices in the face of, I mean, I understand if, as long as inflation continues, housing prices could just continue to go up with it. That's not unheard of by any means. But eventually, I don't think, eventually inflation will get crushed, probably by itself due to demand destruction on the part of consumers, one way or the other. When that happens, I predict inflation, housing prices will come down a lot. But if you've owned your house for at least the last 2 or 3 years, it's no big deal. I mean, but if I was going to sell in the next 2 or 3 years, when will inflation end? And with it, housing prices, any housing price increases. I mean, maybe it already did. Maybe I know real estate agents in my neighborhood, you know, my neighbors who are agents, 2 or 3 of them, who claim it's already turned down around here. Well, I was here in 2000 when the tech market crashed and real estate turned down. But that time it only went down around, I think, 10-15% around here. Of course, we didn't have a bubble. I mean, we didn't have 40% gains in 2.5 years then either. So if I had to guess, I bet real estate in my neighborhood goes down between 20 and 25% over the next 2 years. Jeff, what do you think?
Well, I think you said probably most all of it, other than, you know, if I was going to be in the seller's market anytime soon, I would get busy doing it, because, you know, one of the problems too, that we got some kind of macro problems that are not completely showing up yet. We got a real bad water problem and drought problem it's not even begun to be addressed and talked about, as well as other environmental situations. But you know, again, if it's something that I was really planning on doing, I can't think of a better time than the current market, maybe from here to a year out or so. But that's just my viewpoint based on, and I don't do, you know, we don't do a lot of residential. I work with a lot of commercial type real estate, but I was one of the people that bought a house in this madness about a year ago, so I got to see it up close and personal. So yeah, it's hard to imagine that they're going to go up a lot more than where they are now.
It really is.
Yeah.
I would
Okay,
sell,
so-
if I was going to sell my house, if I knew I was going to sell my house in the next 3 years, I would put it up for sale in the next 2 weeks.
Thanks. Good time to sell, bad time to buy, right?
Yeah, it still is.
Yep,
Mhm.
no doubt
Okay.
about it.
Yeah.
Thank you. Thank you.
And full disclosure, we still are investing in real estate at Secure Retirement. Exactly 2 REITs that Jeff has found. It's hard. You think I mean, finding any asset to invest in that could potentially be involved in any market risk is like a needle in a haystack right now. And with our REITs that we've invested in historically now, we've always demanded a level of safety. I mean, most things are now excluded, but even with our stringent requirements for safety, we still do have two REITs that I love. Just might as well throw it out there now in case anybody's interested. One of them is only for accredited investors, which means a person has $1 million or more invested. It's in wireless technology, cell phone towers. Real interesting business. Awfully hard for them to not grow because of the 5G rollout. And the other one is storage, which has traditionally been the premier, it and from our perspective, it and the right type of apartments for 20, 30 years have been the superior asset classes for commercial real estate investing. Doesn't look like to us anything has changed. The REIT that we're putting money in now in storage is being managed by a guy who has done real well for our clients and done it a long time, phenomenally talented, et cetera, et cetera. And these people pay 5 to 6% in dividends. And at the end, we hope to make capital gains like we typically have. Real good capital gains, typically. We're doing that, but I think it's safe to say, I mean, Jeff and I, our biggest enthusiasm is now for our tactical portfolio, because tactical allocation is designed to do its best time is when there's a lot of volatility, when there's big changes. And boy, I sure see a lot of big changes going on, and I don't see them having done anything but just now started. So with that, other questions, folks?
I have a question.
Yes,
With-
thank you.
Just actually two questions. You were discussing, I'm going back to your last charts that you put up.
Yes, please.
My understanding is, I'm not clear.
Okay,
From February 1st forward, the TAP has produced 5.7%, if I'm remembering correctly.
no, 7 point, I can tell you 1.5, 7.27 since February 1st.
Well, there were two numbers. There was what was the 5.7 then?
That was year to date because we went down the difference.
Oh,
in
got it.
January.
Okay, got it.
Yep.
Okay, that answers that question.
Yep.
Then the other principle I've heard you repeat repeatedly, including today, is that debt, the great thing about debt, or the terrible thing about debt, is it does not disappear.
Exactly.
It does not ever go away.
Yep.
Yet, and that I heard it again, and I said, yeah, but what about bankruptcy? Doesn't it go away then?
Exactly. That is how it goes away. And that's,
Okay, so all right, fine, that's it.
and
Good.
and by the way, this is important. We've got one of the best systems in the world to liquidate debt. In fact, the best system in the world, I believe,
Yeah,
when it comes to eliminating the debt through liquidating it through bankruptcy, while leaving the most number of workers, while leaving the entire productive part still functioning.
yeah.
We have the means to do that. But I'm telling you, back in 2008, I think it was, I really learned it's like the golden rule of investing, which is that the powers that be have spent over 50 years making sure that corporate bondholders never lose money. And in other words, that we never have the real debt liquidation where the bad debt is all tallied up and it's like, well, I guess you lost your 5 trillion. And I wonder if that might be related to the fact that the 5 trillion losses are held mostly by the wealthiest of the wealthy, who happen to run the Fed and the whole financial system and own Congress. But I digress.
I don't think you're digressing. I think you're right on point.
This time, though, I believe there's a pretty good chance, I mean, hope anyway, that our savior will turn out to be that same word called inflation.
Yeah.
Because inflation, when stuff starts burning down, it's hard to, put a sheet over your head. One that's already had everything wrung out of it. Anyway, bad analogy. But anyway, we're in a position now where inflation ties the authorities' hands for anything that could keep this charade up. And that's called a debt liquidation event. And they're not bad things, folks. It's like without debt liquidation, you do not have a capitalist economy, and you definitely will not have economic growth. And lo and behold, over the last 15 years, we've had, the slowest economic growth since, the 1930s. Just as bad, basically. Unless you add in recent growth that is getting killed by inflation. In other words, our economic performance by the end of this time period will be no better than the 1930s. The heist will have happened where the middle class lost by the end probably $60 trillion to some other people who are never named, the ultra wealthy. But anyway, for us, this is a very good time from an investment standpoint. It's the best time because I was worried. I must admit, back in January, about January 20th, I was a little bit worried, thinking, I've created all these years, I've made this crisis-proof investment chair with 4 legs, and 3 of them don't work. The only one working is managed futures because inflation was not part of the plan. Fortunately, having studied it for over 20 years, it wasn't that hard to remodel this chair, and now it's working perfectly. I mean, not every day, but it's doing the right thing. And I predict it will continue to do the right thing as it's designed to do from now till the end of this time period. I just pray it ends with a proper debt liquidation and the losses are finally allocated, not to an average taxpayers, but to whoever made the stupid decisions that led to $3, $4, $5 trillion in corporate debt, in corporate losses. So with that, I do thank you all for bearing with me as I carry on and on about these topics. As you can see, I still enjoy talking about them. They are fascinating. And if you have questions, please let me know. If it sounds like I don't have all the answers, you're understanding correctly. But we are keeping on top of what we need to, particularly the risk and seeing how to benefit from it. So thanks again.
Thank you, Richard.